Hello, everyone, and welcome to the discussion on bonds today. First of all, what is a bond? In India, we commonly call them as debentures. So now you can correlate a little bit, right? What are the characteristics of a bond? First is par value. Par value is also called face value. Now, this is generally the maturity value of the bond. That means the borrower will repay the investor this amount on the maturity of the bond. Coupon rate, also generally we call it interest rate or stated rate. So coupon rate or interest rate is that rate which the borrower, that is the borrowing company, will pay to the investor. Remember, interest amount is always calculated by multiplying the coupon rate with face value, par value. See, understand, market has its own logics. Bond may trade at above par value, that is called premium, or at below par value, that is called discount. But we will always calculate interest by multiplying the coupon rate with the par value. Bond indenture. Bond indenture is basically a document where all the terms and conditions actually, of the bond is written. Like when will the interest be paid? Is it once in a year, semi-annually, or quarterly? When will the principal be paid, and all other terms and conditions. What is credit rating? Before issuing a bond in the market, the company generally has to get their debt rated from a credit agency. In India, we generally have CRISIL for this purpose. In US, we have the big three: Fitch, S&P, that is Standard and Poor, and Moody's. They generally assign credit rating to the bond based on various factors. Generally, the higher the credit rating, more secure your investment or bonds. Now, the topic of today's discussion: how to value a bond. Remember, the value of the bond, that is bond value, equals to present value of all future cash flows discounted at market rate of return. So we have all future cash flows and we will always discount it at market rate of return, never at coupon rate, stated rate, or any other rate, always market rate of return. Now there are only two cash flows generally associated with the bond. One is interest, which the company pays on a timely basis, and then is repayment of principal. Now, because you are discounting the cash flow using the market rate of return, interest is a recurring payment, means it is occurring after fixed time intervals, generally a year or a semi-year also. So there you use annuity factor, whereas principal is repaid only once at the end of the tenure. So there you use discounting factor. So see, interest amount into annuity factor bracket n, that is rate of interest, comma number of terms or years, plus principal into discounting factor PVIF bracket n, that is interest, comma number of years. First, let's see the example of a bond issued at a discount. ABC Limited issued 9%, 5-year, $1,000 bonds of total face value of $10 million. Now this is how bonds are written. What is 9% here? Coupon rate. The rate which the borrower, that is the borrowing company, will pay. What is 5-year here? The term of the bond. After 5 years, the bonds will be retired. And what is $1,000? Par value. So total face value is $10 million. You can also calculate from this data number of bonds that would have been issued. So ABC Limited issued 9% coupon rate, 5 years, term of the bond, $1,000, that is the par value of the bonds, of total face value of $10 million, when the market rate of return was 10%. So what the company is giving, coupon rate 9% and market rate of return was 10%. Calculate the issue price of the bond. Annuity factor of 10 years for 10% for 5 years is given 3.791, and discounting factor of 10% for 5 years is given 0.621. Now as I said you, the value of a bond is present value of all future cash flows discounted at market rate of return, never the coupon rate, which in this question is 10%. First, so there are two cash flows, interest and principal. So let's calculate the interest first. We multiply the face value with what? Yes, coupon rate. Because this is what the company has agreed to pay, 1000 into 9%. So 90 every year will be paid for 5 years. 90 will be paid first year, second year again, third year again, fourth year again, fifth year. Principal will be repaid at the end of the term, $1,000. So bond value is PV of interest plus PV of principal. That is 90 into annuity factor 10%, comma 5 year, because it is a recurring cash flow, plus 1000 into discounting factor 10%, comma 5 year. So you will have 90 into 3.791 plus 1000 into 0.621. That will give you 341.19 plus 621, that is $962.19. In this case, bond has been issued at a discount. Right now it is less than par value. Now why has been bond issued at a discount? See, market does not cares what coupon rate you fix for the bond. Market will ensure that everybody earns what similar bonds are offering. So if your bond, let's say, is AA rated, whatever other AA rated bonds are giving, market will ensure you also, sorry, they also earn the same on this bond. Now cash flows are fixed, right? Interest is fixed, maturity amount is fixed. So how do I earn more? That is, market rate is 10%, by simply buying it at a discount. So always remember, whenever your coupon rate will be less than market rate, bond has to be issued at a discount. Otherwise, how will I earn more from the same bond? By buying it at less price. And the valuation method is shown here. You have PV of interest plus PV of principal. Remember, interest is always calculated by multiplying par value with coupon rate, but they have to be discounted at market rate of return, because market is offering more in this situation, 10%, you are offering less. So market will ensure that from this bond also they earn 10%. How can they earn 10%? Cash flows are fixed, by buying it at a discount. Bond issued at a premium. Same question, only the coupon rate has been changed. ABC Limited issued 11% coupon rate, comma 5 year term of the bond, comma $1,000 face value. Bonds of total face value $10 million, when the market rate of return was 10%. So in this case also, market will ensure everybody earns the same rate of return. So everybody will be earning 10% from this bond also. Calculate the issue price of the bond. Annuity factor of 10% 5 years is given 3.791, and discounting factor of 10% 5 years is given 0.621. Now interest amount, again you will calculate by multiplying the par value, that is $1,000, with coupon rate 11%. So it is $1,000 into 11%, that is $110 every year for 5 years. At the end of year 1 you will pay $110, at the end of year 2 you will pay $110, and so forth till 5th year. So PV of interest plus PV of principal. So you take the interest amount 110, and because it's a recurring cash flow, into annuity factor. What? Market rate of return 10%, comma 5 year. Plus 1000, this is the maturity value. So once cash flow only, discounting factor 10%, comma 5 year. So 110 into 3.791 plus 1000 into 0.621. This gives you 417.01 plus 621, that is 1038. So in this case, bond has been issued at more than its par value. That means it has been issued at a premium, and it is logical also, na? You are offering 11%. Similar bonds with similar credit rating, similar debt is to equity ratio, and similar capital structure are giving 10%. So that means you are offering more than the market. Market will ensure everybody earns 10% from this bond also. How? By buying it at a higher price. So in the previous example, when you were offering 9% and market was offering 10%, people bought it at a discount because market will ensure everybody earns market rate of return only, that is 10% on this bond also. In this case, you were offering more than the market, 11%. Again, market has to ensure that everybody earns 10% only, and the cash flows are fixed. How do I ensure that? Bond will be issued at a premium. Market takes care of it. Last, bond issued at a face value or par value. ABC Limited issued 10% coupon rate, 5-year term of the bond, $1,000 bond, face value $10 million, when the market rate of return was also 10%. So you are offering 10%, market is also yielding 10% only. Calculate the issue price of the bond. Annuity factor of 10%, 5 years, 3.791. Discounting factor of 10%, 5 years, 0.621. So interest amount, again you multiply par value with coupon rate. So $1,000 into 10%, $100 every year for next 5 years. Bond value, PV of all future cash flows discounted at required rate of return. So you have PV of interest plus PV of principal. Interest, recurring cash flow, so annuity factor. So 100 into annuity factor 10%, 5 year. Principal, one time cash flow, so discounting factor plus 1000 into discounting factor 10%, comma 5 year. So 100 into 3.791 plus 1000 into 0.621. That gives you 379 plus 621, exactly $1,000. In this case, bond has been issued at par value. Why? You are offering also 10%, market is also yielding 10%. So your bond will be issued at par value only. So remember the conclusion of this session, and this is very important for bond analysis. Whenever market rate of return, or people also call this required rate of return or yield to maturity, is greater than your coupon rate or stated interest rate on the bond. In this case, market is giving more, you are giving less. So how does market earns more from the same bond? By purchasing it at a discount. If market rate is less than coupon rate, that means you are offering more, market is offering less. How do market earn same from this same bond? By buying it at a premium. And if market rate and coupon rate are absolutely same, bond will be issued at par. So that's it for this session, guys. We'll see you again in next session. Till then, have a good day, everyone. Thank you.